Hi, I'm Josh Melberg. Today, I'm going to discuss about the world of conservative investments. Many of you are people out there looking for a safe place to put your money. Maybe you're looking for income-producing vehicles, and you don't know where to go or who to trust. And a lot of times, people are feeling that way is because they're told what they're in is safe because I'm in a bond fund or I'm in a balance fund. And the next thing I knew, I look at my statement and I lost 10%. How can this be safe? Because I lost money. So I'm going to share with you a couple of ideas of how people are choosing the world of conservative investments out there and why many people out there are putting their money in different places that they think it's safe, and then they look at their statement and why things are going down. Let's take an example. I'm going to break down the different types of vehicles, investment vehicles, from riskiest to most conservative. And I'll place it here on the board. But in the investment world, we have kind of a teeter-totter here where we have the most aggressive vehicles, which would be stocks, mutual funds, exchange-traded funds, and variable annuities, which also are like mutual funds, because we know everything on this side is going to go up and go down. We know that's going to take place. That's what the market does. The safest is going to be CDs, government treasuries, TIPS. TIPS stand for Treasury Inflation Protection Securities. They're T-bills. Fixed annuities, and tax-free municipal bonds. Now here again, there's good terms and not so good terms, but today's ranges, you should expect anywhere from 2 to 4% rates of returns, depending if you go short-term versus long-term. Then you have the moderate category. The moderate category is going to be corporate bonds, preferred stocks, index fixed annuities, and REITs, real estate investment trusts. And these generally range 5 to 8% per year. Now for your viewers out there, you could probably find something wrong with any one of these, but you could probably find good examples for every one of these as well. There used to be a time in the Jimmy Carter days where you can get CDs at 12, 14%. Now they're paying a lousy too. So that's not the case the way it is today. What really matters is the terms of the vehicle, not so much the vehicle itself, but it's the terms of the vehicle, because that's what's going to dictate the success of the outcome that you're looking for. Now, many advisors say you're diversified because you're diversified all in one category, but all the money is in one category. Now, today I'm going to share with you some general rules regarding retirement income planning. Retirement income planning is different than growth and accumulation. Retirement income planning is more about preservation and income on your money, not necessarily growth and accumulation. Let's take an example. Here's some guidelines that are suggested for people that are retired or near retirement. And one guideline is called the Rule of 100. The Rule of 100 simply suggests that if you're 65 years of age, you take your age, 100 minus your age, consider not to have more than 35% of your money, in this particular case, inside the market. And my definition is anything that can lose 20% in a year because it fluctuates. Because they came up with this, if you're 65, the earning power to go back to work becomes less and less, number one. Number two, we know everything out there in the market is going to go up and go down. So every time you take a withdrawal of your account, think about last year or when the market went down, all those people that had to pull money out of their accounts and the market went down, all that money they took out did not have a chance to recover when the market came back up. So there's two reasons. One, if you lose 40%, the earning power to make it back up may not be there. Number two is every time you sell a share, you could sell it as a loss. So when you're working, you're putting money into the market, it's called dollar cost averaging. When you're retired and you're pulling money out, it's called reverse dollar cost averaging, which eats it away, erodes the principal even faster. Now, obviously, if you have multiple millions of dollars and you don't need this money, then you can have a much higher percentage in the market. Obviously, if you have hundreds of thousands of dollars of income from pensions and other places and you don't need this money, you could have a much higher percentage over here in this category. But if you depend on this money and you can't afford to lose it, or you may need it at some point for income to cover some of the basic living expenses, these are some guidelines. One is called the Rule of 100. Now, a lot of people say, well, I have bonds. I have my money in bond funds. I have my money into balanced funds. Half the money's in stocks, half the money's in bonds. Well, technically, if it's in a bond fund, it goes over here. But if you bought the bond directly, it goes over here. And the reason why is because if you hold that bond to maturity, then you can hold it without selling it for a loss as long as the bond matures. Whereas if you have a bond fund and interest rates go up, you can lose 20% on your money. So if you have a bond fund, it goes over here, but if you own a bond directly. There's only two ways to make money. One way to make money is called safety. The opposite of safety is risk. So if you want a guaranteed rate of return, you can go to the bank and you're going to get a very low rate of return. But if you want a higher return, you can go from over here to over here, which is mutual funds. But we don't know what this is going to be. Long term, hopefully it's over a period of time, it'll do very well. The only other way to make money is called liquidity. The opposite of liquidity is called time. For example, we keep everything liquid and safe. It's called a savings account earning less than 1%. Liquid goes from 0 years all the way to 30 years. 30 years means you can make up to 9% on your money if you buy a long-term bond or preferred stock, but you know what you're going to get when it matures, as long as they're in business. If you go 20 years, you're going to make 8% on your money. If you go 10 years, you can get 7% on your money. It's never right to put all your money in the market, in mutual funds. It's never right to put all your money in 30-year time frames. But people choose a combination of these vehicles to achieve what they're trying to make. So the important thing that you're going to want to look at is if it's a REIT fund, it goes over here. If it's a bond fund, it goes over here. It's a balanced fund, it can go over here. Why? Because they don't have maturity dates. They don't have maturity dates where you know exactly what you're going to get if you hold to maturity. So if you have a portfolio, one of the things you're going to look at is, one, you're going to ask yourself, what's my risk tolerance? Am I aggressive or am I conservative? Can I afford to be aggressive? Can I afford to be conservative? What do I feel? Do I think the rule of 100 is suitable for me? Do I think that's a good factor? Everybody has a number. Everybody has what they feel. Some people say, you know what, in today's market, I don't want to take any risk. I don't think I need to be over here. I would much rather be in moderate or conservative categories, even if I only make 2 to 8% rates of return. But I don't want to be necessarily in funds, because those have been performing well lately. The other question you're going to want to ask is, what is my family index number? Everybody has a family index number. The family index number is the rate of return you're trying to accomplish. So some people say, you know what, I only need to earn 2 or 3%, and as long as I keep what I have, I don't lose it, I'm fine. Other people say, I'm really trying to achieve 6 or 7% per year. Once you know what you're trying to achieve, the more specific you are, the much easier it is to pick these different types of vehicles and the terms of those vehicles. Once you have that family index number, let's say it's 6%, that's what you're trying to achieve for the time being, it's much easier to pick which vehicles you want to choose, and we want to take the least amount of risk possible to make that return, not the most. What you'll find, there's a lot of people that say, you know what, I'm happy with 5 or 6%, but what they do is they put everything over here, and they risk everything over here, and that's why so many people lost 30 and 40%. Even though some of it popped back up, that can happen again. And a lot of people don't have to take all that risk and put it in mutual funds and stock funds and balanced funds and ETFs to get that rate of return. They can do it in moderate or conservative categories to get that rate of return. But they're going to look at time categories versus risk. Now, once you know what your family index number is, whatever that rate of return you're trying to accomplish, before you figure that number out, you may want to consider another retirement rule or a guideline. It's called the prudent man's rule. The prudent man's rule, and there's a couple of different examples of how to come up with that, is also known as the 4% rule. The 4% rule simply suggests that you can take 4% out of your investments out every year, and if you draw 4% of your investments every year, you should not have to worry about outliving your income or changing your lifestyle as long as you're not too aggressive. And hopefully you're making a higher return than 4% on average, and therefore you have increasing income. A lot of people are taking 8 and 10% of their investments, and they could deplete their investments in 10 or 12 years. And some advisors say that you can take as much as 5% out of your investments per year if your investments are structured for income. For example, you can have two investment vehicles. Investment vehicle A will go up and go down and averages 7%. This would be an example of a stock fund, mutual fund, balanced fund. And if you have $100,000 and you're taking income out every year, 5 years from now, because all those shares you sold when the market was going down did not have a chance to recover, even though it's averaging 7%, you may only have $70,000 left. Investment B is more like a bond. It just kicks out income. It kicks out dividends. The $100,000 kicks out 7% interest, 7% per year, but when that bond matures in 5 years, you still have $100,000. Investment A, stock funds, mutual funds, things of that nature, is designed for more about accumulation and growth when you're working. You can buy shares at lower costs, and you should be able to do fairly well. Investment B is designed for more preservation and income. How can I maximize the income off my money? And a lot of people are structuring their investments where they take all their money out over here in the market versus having it structured for income. So if your money is going to be all in the market, you may want to stick closer to the 4% rule, or the high percentage of the money is in the market. If you structure your vehicles in insured income producing or bonds or things of that nature, you can take a higher percentage of your assets every year to potentially reduce the amount of outliving your income. Remember, if you're in your 70s and you have $500,000 and you need $25,000 a year, even if you did not make one dime and it was all under the mattress, that will buy you 20 years. But if your money's in the market and your $500,000 goes to $250,000, that will only buy you 10 years because now you're taking a much higher percentage. It's almost more important not losing your money than making money. Now, you can still make money, but taking the risk to make the time frame isn't there to make it back up. The cost and the time frame to make it back up is more important than making a higher yield.